You're watching Stockwatch. I'm Simon Brown. Joining me to unpack your stock-related questions today, Cobus Potgieter from Southern Cross Capital, Ricus Reeders from PSG Hole Ruimsig. Be sure to send your questions. Email stockwatch@bdtv.co.za, SMS 41392, or on Twitter @BusinessDayTV, #Stockwatch. Gents, thanks for joining us. Ricus, let's start with you. Question coming through around back from Friday, Thungela Resources. And the question is simple. I should have sold an age ago. Hindsight, we've all been there before. Sell now or continue holding? It's tough being a single commodity stock when your commodity's under pressure. What's your think on, Ricus, on Thungela at this point?
Look, it had a bad reaction on its results. It's recovered somewhat, so it's essentially going sideways for the moment. I think there's future interesting things happening with Thungela. You know, their gas plant in Limpopo, if they can get that going. The expansion of their current mining products. There's obviously also the Transnet thing, you know, if that can become effective, the trading office they're opening in Dubai. So it's all factors that could influence future operations. But for the moment, they need their single commodity stock to increase in price to get their share price going. I know Cobus don't really look at squiggly lines on graphs, but I mean, I wouldn't want this share price to go below the sort of 80, 82 Rand level, because then there's downside ahead. But in the meantime, I think that they, in the resource sector, probably better opportunities elsewhere, even if you just want to diversify in order to get away from the risk of whatever the gold price is going to do in the short term.
Cobus, for you, Thungela, because a lot of folks will say, what about Exxaro? It's the same story. They've got some iron ore, but of course, another commodity not doing great, and they've got some green. But for you, Thungela?
I like pure plays. Ricus mentions I don't like technical analysis, nor do I love resource stocks. but ultimately, this is quite a pure play, like you mentioned, single commodity exposure. And I'm of the view that the outlook for coal is a little bit rosier than what's in the price. And frankly, I mean, just given how Thungela, the trading statement we just saw, the market is really discounting its future expectation because it would be significantly cheaper just looking at this single set of results coming up. So as sort of that pure expression of taking a view on that single commodity, in addition a little bit, I guess, to around the Transnet execution, having geared exposure to that. That's why I've always, if I had to choose a gold miner, it would be the marginal gold miner, because the likes of Harmony, because I can get more gold exposure for cheap, as a percentage of my total portfolio. From that perspective, I do like it, but again, not sort of as a concentrated call, more as a way to express that view within your portfolio. If you do like coal, believe there's upside to that commodity.
Yeah, gotcha. And there is, and I mean, we've seen it in the gold miners. And they've all done excellent, some more than others. To your point, the marginals perhaps better. Cobus, let's stay with you a moment. Question coming through around Pepkor. I'll hold it. Like the company, ask your esteemed panel, is it worth keeping? Would you hang on to Pepkor at this point, or would you rather something else or nothing in the sector?
No, I love Pepkor. Excellent business, well run, continues to find new avenues of growth. Taking on Mr. Price a little bit in that space, so I mean that's a little bit dog-eat-dog zero sum, but beyond that, it's a great business. And if I had to get technical around call it market dynamics for a second, the fact that we finally saw the Reserve Bank settling with creditor holders, and that overhang disappearing, through an overnight book build with enormous support.
Yeah.
That does show, sort of a big institutional belief that the share is well priced. So from that perspective, I think this is a good point to get in.
Yeah, I'd actually forgotten that, of course. And to your point, I mean, there was a big slice that came to market, and the market was more than happy. Ricus, I know you like Pepkor. I'm imagining that not
Yeah.
much has changed to change your mind.
No, I absolutely agree with Cobus, and yeah, I would certainly hold it and possibly buy it.
Staying with you, then, Ricus, while we're here, question coming through around Italtile. In fact, they had a trading update early this morning as well. The question was, back at pandemic levels, surely it's worth a look at this point. The update this morning, it's tough out there. They're talking around cheaper products. They're talking around a consumer under pressure. But it is where it was in those early 2020 levels. Ricus, would that make you interested?
It's always worth a look because it's a very well-run company, and then you can look away again because it's in the results. And we've seen it, whether it be the banks, the other retailers, the SA consumer is under pressure and will remain under pressure until some stage we can get growth going. And that depends on government's attitude towards its own citizens as far as legislation is concerned, and also to its, to America, which is the second biggest or third biggest trading partner, until the signs align to, as I said, to make the economy more rosy going forward. Things like Italtile is going to struggle. Doesn't matter how well managed they are.
Yeah, I take your point. I mean, we can make an argument that the consumer's better off than a year ago, but we cannot make an argument that the consumer's in a good space. Cobus, it's a towel for you.
A tricky one, and interestingly, looking at the results over the last 3 years, they've sort of, in a very difficult environment, managed to post the same set of results, more or less, within a few percentage points every year. And it was the subject of this SA Inc. Inflation narrative last year. It went through an enormous rally. Through all of that, the operational performance barely shifted. It is a lot cheaper now, I must say. It's if you're paying a lot less for the same results for a well-run business. And I guess, as a participant in this market, having to hold SA equities, yeah, I agree. Ultimately these guys need friendlier policy, pro-growth policy. We need GDP expansion for them to see substantial secular growth in the business. But at the same time, if I were going to hold the stock and sort of bet on an outcome given valuation, this is a very attractive valuation. So I think Italtile is worth a flatter. And at least, as you mentioned, there are signs that the consumer the sentiment is improving somewhat. So using this as a way to express that view, perhaps participate in that upside. I like Italtile at this level.
Cool. Okay. So yeah, and I get your point. It is same profit, better price certainly makes better valuation. Cobus, a question coming through around Greencoat renewables. The first part of the question was, I asked when it listed, but no one seemed to have any insight. Is there any insight from the panel on Greencoat? Cobus, have you had a look at it?
Briefly when it listed, but to be honest, no. There's zero liquidity in that share. So it's sort of one of these phantom listings that the SENS announcement come across in your brain is programmed to miss. So I can't offer any insights.
Yeah, there've been zeros. There's a bit of volume, but I mean, really, it is a private client volume at this point. Ricus, Greencoat renewables for you?
Yeah, they're interesting. As Cobus said, not a lot of liquidity, so you're not going to get huge institutional interest in the company itself. But yeah, operating wind farms and renewable energy, concentrating on the UK, which is the one point that bothers me. And that's just because of government interference or non-interference, or the UK itself, where at the moment there's a problem as far as regulating the industry is concerned. And so you've got a bit of political risk as far as that exposure is concerned. And then just in general, if you're operating a company that depends on the way the wind blows, you might have quite earnings might vary. So in the right kind of sector, but as I said, the geography bothers me a little bit, and then also the variability of earnings. So it's not something. I think there are better ways to expose yourself to the energy needs or the global energy needs of the future.
Yeah, there are a bunch, and like your point, yeah, when the wind blows, yes, we'll take that absolutely. Question just came through on the emails. Ricus, Nvidia, and I think we've got results from them in about 2 weeks, maybe there's about. They're the last of the big stocks to give result. The question is, hold or sell. So obviously, if you're holding, I mean, it's doubled since since the liberation lows of back in April, $180 on Friday. Ricus, would you be holding or selling at this point?
I'll probably be holding it just as a momentum play. I mean, I don't think the growth story behind Nvidia is unknown, although I do see that 15% of their revenue has now been effectively nationalized by the US government. So yeah, there is that regulatory risk, but and I think a lot of that also depends on when is the China trade deal expiring tomorrow. So what kind of deal they get as far as chip imports are concerned. But yeah, I would stay with market momentum and just hold it for the moment.
Yeah, so I think the deal was announced yesterday. So I think it's AMD and Nvidia. They can sell to China, but they got to give 15% back to, I'm not sure who, the White House, Treasury, someone. Anyway, it's a weird deal. Cobus, you're not much on the offshore side, but with a minute to break, I mean, Nvidia, it is a spectacular chart. What do you look at when you see a stock like that, which truthfully has just got insane momentum? Do you hang on, or do you at some point try and dismount elegantly?
I'm tired of being cautious on Nvidia. It's promo stock. And to some extent, this very strange reverse tariff deal was negotiated by AMD and Nvidia. And I'm assuming the understanding is that means that in the opposite direction. So this is very odd. For every chip that they export to China, and it has to be those chips that have been pre-approved. For that, they sort of cut down chips. For Nvidia, in particular, AMD less so, they have to pay 50% of the revenue that they back to the US fiscus. That's a very, very strange sort of outcome. I think it's going to allow the arbitragiers to make a lot more money by buying those things through other jurisdictions. But in any case, at least it's a negotiated deal, and hopefully they can still get a better outcome for tariffs in the opposite direction. But ultimately, it's something you've got to hold. Would I be overweighted at this stage? Probably not. There's still a lot of perfection priced into it, but it does seem to be more motive than any of us thought, given AMD, which is really the eminent opposition to Nvidia, being able to execute in that market, and the AI investment seeming to not be tapping off as we thought it was perhaps earlier in the year. These guys will continue to sell a lot of GPUs. So it's something I would hold on to, but perhaps not as concentrated.
Yeah, and I like your point. I hadn't thought there must be an arbitrage there somewhere. Question coming through, Rick, let's come to you. New CEO at Growthpoint. Stock's been doing nicely for me the last couple of years. I assume not to worry. Ricus, I mean, the CEO is what we, I suppose, could call an orderly transition. Your thoughts on Growthpoint? And I suppose we could say it's at multi-year highs, not beating them just yet. Growthpoint for you, Ricus?
Yeah, I think it's fine. I mean, the sort of average tenure of that board is about 7.5 years. So it's they're competent. They know what they're doing. As you said, the transition is all according to plan. So there's a lot of management depth there. So I think changing CEO is not going to change the course of the company.
Yeah, absolutely, and it's that sort of experience. Cobus, for you, Growthpoint, new management at the helm, and let's be clear, the management's happening sometime next year, and I think sort of maybe mid next year or even late. Cobus?
As one would expect from Growthpoint, it's sort of the institutionalized REIT in the South African space, at least. This is a very, very well managed handover period. There's even a sort of from where the current CEO steps away, 6 months of overlap before his contract finally expires, we'll have a situation of deal leadership. So that's just business as usual. I guess what's slightly more interesting announced with this is Jose Snyder being poached from Liberty 2 Degrees, also another high quality REIT. He was the CEO there, becoming the CFO or the CFO in waiting at Growthpoint now. So it's a quality team, it's a quality operation. The product mix is perhaps, or the sector mix is perhaps been a little bit unlucky relative to some of its peers, but it remains an excellent, well-managed REIT and probably the highest quality exposure one can gain on the JSE.
Yeah, it does. From the VNA onwards, it is a ton of quality assets. Cobus question, after removing their Boxer holding, Pick n Pay is essentially free, or am I missing something? Surely this is opportunity. Cobus, if you take out the Boxer stake, there's not much left on the balance sheet of Pick n Pay, and you are getting it, as I understand, almost for free, maybe $1 billion or $2 billion. Does that give us opportunity?
One could take that view. It's got an enormous holding company discount. One could also take the view that the market is pricing that the equity is worthless inside of Pick n Pay. The value of Pick n Pay is so negative that it offsets the value of that Boxer holding, ultimately. And I'm somewhat of the view that that's what we see, a dying animal that will continue to slowly lose ground, and now and again it'll go back into the piggy bank and sell some of its Boxer holdings to recapitalize, to continue investing into that business. But ultimately, it's a tough environment. The years of 2% operating profits or gross profit that we can pay are long gone. Boxer is a very attractive growth asset. I will just take my Boxer exposure directly and leave that optionality off the table. And I'm usually the guy that loves going for these cigarette stunt type opportunities, but this one, I don't believe in the team of Sean Summers to turn it around.
Yeah, okay, and I take your point. Yeah, and it's something you would normally jump at, but maybe not this time. Ricus, Pick n Pay for you with, maybe, I don't know, are we buying Pick n Pay for free with the slider Boxer? Or...
Yeah, I think Cobus alluded to it. When we get into this, when you look at the statements, then X, Y, and Z, it doesn't tell you anything about how much SURF or OMO the company is moving off its shelves. If Pick n Pay was a business with potential or on the brink of a turnaround, then I would say, okay, maybe we can start looking from how they're doing operationally to what the financials are looking. But starting at the financials and then saying, well, the financials are forecasting a very good operational environment is the wrong way around. So no, I agree with Cobus. If I want to be in that Pick n Pay Boxer space, I'd rather just go and buy a Boxer and leave the Pick n Pay for the guys that like financial engineering.
Yeah. No, I get your point on that. Question coming on Coronation, being a great stock. I know that much of the panel, people who come on the panel are preferring 91, but it's been great. Has it got more potential upside? Ricus, from a chart perspective, that is a beautiful looking chart. Your thoughts on Coronation?
Yeah, so you tick that box. I think probably about 15% price-wise, but is it going to change the way they do their business? No, they still need a distribution arm. Obviously, if one takes a look at the investment portfolio, heavily weighted towards resources, they might gain from there. But longer term, if you want to be in a financial services type of company or in a fund management type of company, I would still prefer 91 and one other I won't mention.
One other you won't mention. Cobus, for you, certainly, the market goes up, they just make more money because the ORM goes up, and then if they get some alpha on top of it, there's more jam to it. You're thinking on Coronation?
That's a pretty good thesis. And I think your problem, Simon, is you have a bunch of asset managers and you're asking them to come into other asset managers, which is sort of a profile. You're not going to ask the CEO of ShopRite what he thinks about pay. But not that I'm saying that's the level Ricus and I play at, maybe he does. But yes, get exposure to the market. In terms of exposure and quality of execution, I do prefer 91. The siloed model lends itself to sort of boutique excellence. Given that you have these 5 very divergent styles that hold themselves up independently. So yes, it's a nice play, but the way it's managed is sort of one big behemoth. Part of the reason they're so heavily in the resources is because that's where they can find liquidity. So I don't see them able to generate as much alpha in the long term. Whereas 91, despite being quite chunky, obviously, there's a lot of upside there. They have they've got limited retail exposure relative to the other big name asset managers, and that's starting to pick up steam in the wake of the Sunland deal. And on top of that, I like their investment styles substantially more, so back then to generate more alpha than Coronation could.
Yeah, and I get your point around the size. And I mean, the commodities are absolutely the right call for now. At some point that'll change, but we won't argue with that. Cobus, staying with you, Tiger Brands. We talk a lot about turnaround stories. Usually we talk about them with tears in our eyes. Tiger Brands has kind of worked, and the question is, it's been great. Is there more upside here?
This turnaround has been absolutely perfectly managed. Got to give Charles a lot of credits. And initially, when they replaced the CEO, I was a little bit skeptical that he would have the sort of clout to do what needs to be done. But ultimately, within months, we saw movements on the board itself, within Exco, and then senior positions outside of Exco, the same. Just people slowly and surely sort of being atrophied or replaced, or managed into positions. And the execution there has been pretty good. It's a really nice business. So I suppose there was a lot to say. It has rallied substantially from those levels. We sort of infamously called that it missed out on the SA rally, but it's more than caught up in the subsequent to date. But the valuation remains, it's pretty cheap still. So I still like it. I'm still long Tiger Brands at present. I think it's got some way to go. At this stage, it will be more sort of market factors that drive it, but ultimately undemanding valuation, good management team in place now. I expect it to continue performing pretty well.
Okay. Ricus, we're not going to get your 5 cents because we need to go to some stock picks, and maybe it's $5, not 5 cents. Ricus, Datatec.
Datatec, yes. I've chosen this one before. It's down about 15% from its high. That includes a special dividend, but I think it's back into Bible level. Historic price index of about 13. I think that should be closer to about 18 if you take a look at their peers. Their margins are looking better, specifically as they move into more annuity type software sales kind of thing, and they are in the right sector. As people expand their network to cope with the boom in AI. So I think fairly to pretty well or pretty good value at current prices.
Datatec from Ricus. Cobus, Absa, results next week sometime. I can't remember which day, but results coming through and you're picking Absa with the new CEO.
Yes. So I guess it's slightly risky given results coming. Standard Bank reporting later this week, in fact. So in the wake of the sell-off, but partially lends credence to it. The market didn't like the Nedbank results. I think the market actually didn't like the EcoBank transaction, despite exiting a long struggling subsidiary in the rest of sub-Saharan Africa. The pure SA play means the ROE expectation effectively goes backwards because that was an winning style for them.
Yeah.
Whereas Absa has gone in the opposite direction. And one of its 2 largest markets, Ghana, seems to have made a miraculous recovery. in the last year or so. That's off the back of a buoyant gold price and a few of the other commodities which they export, and that bailout, IMF bailout turnaround story has worked out quite well. And ultimately, Absa expected to be better hedged in the cutting cycle to suffer less from the reverse endowments effect. And that's essentially the difference between what you can borrow and lend at as a bank. In the hiking cycle, the banks seem to benefit. And in the cutting cycle, they get the opposite effect. But Absa is hedged relative to its peers in that space. And I think the space overall is still quite attractive, quite cheap. And it's just my favorite player within that space, given that we are in this cutting cycle now.
Yeah, and gold's been good for them. So is cocoa beans, because there's a chocolate eater. Chocolate's gone completely crazy, and they've done great from that export. That's all for Stockwatch today. Thanks to our guests, Cobus, Potgieter, Southern Cross Capital, going with Absa, Ricus Reeders, PSG Hole in One, Ruimsig going with Datatec. Up next, the close. Stay watching.